Tokyo, the financial world held its breath this week as the Bank of Japan met to deliberate its next steps on the long-winding road of policy normalization. With a showering of confetti or a crashing crescendo, the central bank could have signaled a dramatic shift in its maverick stance. Instead, it left investors suspended in a limbo of wait-and-see, teetering between tightening and lingering stimulus. In a move that surprised many analysts, the BOJ opted to keep the details of its plans to pare bond buying under wraps until its next policy meeting in July. This deferral sparked a renewed bout of yen weakness and a rollback of bets on an imminent interest rate hike, dealing a temporary blow to Governor Kazuo Ueda's professed campaign to dismantle Japan's monetary mother of all policy bombs. The yen reacted with a slump of as much as 0.6% against the US dollar in the wake of the announcement. Government bond yields reversed course, benchmark 10-year bonds rising as traders rethought the timing of an expected rate increase. Meanwhile, Japan's beleaguered equity markets managed a counterintuitive rally amidst the broader regional sell-off. To the casual observer, this may seem like a jumbled maze of numbers and cross-currents. But at its core, the BOJ's indecisive standstill epitomizes the delicate ballet its policymakers must perform in attempting to wean the world's third-largest economy off its trillion-dollar hangover of unconventional monetary policy. For the better part of a decade, the BOJ has been the maverick outlier among major central banks, its bold experiment in monetary supernova keeping its foot planted on the fiscal accelerator even as peers like the Federal Reserve pumped the brakes. But with global inflation soaring and the yen plumbing depths not seen in decades, there are growing calls for the guardians of the Japanese economy to reorient themselves. Governor Ueda, the newly installed former academic tapped to steer this course correction, has made clear his desire to gradually return the BOJ's policies to some semblance of normality. The March abandonment of its controversial yield curve control program was the opening salvo, an unmistakable signal that the era of money helicopters was ending. Yet as Friday's announcement underscored, the road ahead is hardly a straight line. A rapid withdrawal of support could destabilize Japan's still fragile economic recovery and spark ructions in its gargantuan sovereign debt markets. With the BOJ owning over half of all outstanding Japanese government bonds in its $6.4 trillion portfolio, any missteps could be catastrophic. The BOJ is being cautious and buying time, said Mario Washida of Daiwa Securities. It's unlikely they will raise rates in July when that now coincides with specifying the bond reductions. Around one-third of economists had penciled in July for the first post-pandemic rate hike, a milestone many now see delayed to later in 2023 or even 2024. Lurking in the background too is the specter of yen weakness and the risk of destabilizing capital outflows if policy divergence with the US widens further. The yen's precipitous 26% slide against the dollar over the past 18 months has already set off klaxon warnings in Japan's corporate boardrooms and triggered uncharacteristic verbal interjections from finance ministry officials fretting over the hit to purchasing power and profits. Though styled as mere bond operations by central bank officials, the specifics of the BOJ's next maneuver on paring its 6 trillion yen, $38 billion, in monthly debt purchases could essentially amount to the world's last remaining major quantitative tightening campaign. While the Fed has started the process of winding down its own balance sheet, the sheer scale of the BOJ's footprint means its retreat risks convulsing global bond markets. Governor Ueda thus finds himself caught between the Scylla of mounting inflation and plunging exchange rate, and the Charybdis of risking financial chaos and economic setback. As the world's financiers pore over every syllable of his remarks, the former academic must walk a tightrope of communication, carefully signaling an unlimited resolve to restore monetary propriety while safeguarding against precipitous market shockwaves. Transitioning off the potent medicine of radical monetary policy was never going to be an easy affair. The BOJ now straddles perhaps the thorniest dilemma in the annals of central banking, caught between resisting the inflationary contagion sweeping the globe and buttressing Japan's own brittle economic foundations. With Friday's punt, the can has been kicked ambiguously down the road. But investors would be wise to buckle up for more twists and turns ahead. As Japan exits the wilderness of unconventional policy, the journey promises to be a fraught, delicate trek back towards normality, fraught with pitfalls at every turn. For Governor Ueda and his masterful team of savants, Keeping their balance will be the ultimate test of steady hands and sure footing.